It's Friday, 8:30 a.m. Eastern. The non-farm payrolls report flashes across your screen, and it beats expectations by 100,000 jobs. You execute the trade. You go long on the US dollar based on that green headline. But instead of rallying, the asset collapses. Your position is liquidated in seconds. The logic connecting raw job creation directly to currency strength is broken. The headline number has become a source of noise rather than a signal. This chart illustrates the shift. In an AI-integrated economy, productivity can scale independently of human headcount. This creates a divergence where national output rises even as traditional manufacturing and clerical roles vanish. Trading that top-line employment number is a mathematical trap. To survive, you must look beneath the surface and track the exact metrics central banks monitor. Inside the Federal Reserve, policymakers evaluate the economy through a dual mandate. They try to maintain price stability while achieving maximum employment. If the economy is running at full capacity, but inflation is creeping past targets, high employment becomes an active threat. It tightens the labor market and creates a wage price spiral. Because of that threat, average hourly earnings is the metric that actually dictates market movement. It serves as an immediate leading indicator for inflation. This illustrates the disconnect. Despite a massive headline beat of 300,000 jobs, if wage growth flatlines, the consumer economy stalls. Central banks interpret this lack of wage pressure as a green light to cut rates, sending the US dollar tumbling. Institutional capital prioritizes the quality of those wages over the sheer quantity of jobs created. The way employment data is collected creates plenty of noise. The establishment survey counts total jobs, while the household survey counts employed people. They frequently contradict each other. If an individual takes on 3 part-time gig economy roles to pay rent, the headline number lobs 3 new jobs. 0 new people actually entered the workforce. This perverse dynamic creates environments where terrible economic data, like a jump in unemployment, actually triggers explosive market rallies as traders price in a dovish pivot. When the unemployment rate spikes, traders immediately assume the central bank will stop tightening monetary policy. Risk on currencies tied to global growth surge upward, precisely because the domestic economy is faltering. As a trader, you have to anticipate these reactions. Weak economic health routinely acts as the primary buy signal for risk assets. To trade this environment, you execute entirely on how the actual data deviates from the market's forecast, completely ignoring the raw number itself. The monthly payroll report looks backward. Weekly initial jobless claims look forward, serving as your early warning system. And if you observe 4 consecutive weeks of rising claims, the probability of a weak monthly payroll report significantly increases. It signals that the labor market's momentum is slowing in real time, well before data is finalized. This graphic breaks down real wage growth. You calculate it by subtracting inflation from nominal wage gains. If wages grow by 4%, but inflation consumes 5%, the average consumer is mathematically losing money. That creates a strongly bearish outlook for the currency, regardless of exactly how many temporary jobs in the headline claims were added. The modern market zeroes out accounts reacting to surface numbers. It rewards traders who look past the noise and position themselves for the structural reality. Stop trading the top-line number. Open the FXNX economic calendar. Set your custom alerts for average hourly earnings deviations and execute your edge on NX1.